Today, let's talk about one of the most popular dividend growth investing stocks, Realty Income. There are a few givens in life, but here's one. Realty Income markets itself as the monthly dividend company, so the folks there will do everything in their power to pay the dividend every month and grow it every quarter. So it wasn't too surprising when the company announced a few weeks ago that it was increasing its dividend by 5.1% on a year-over-year basis. Since going public 27 years ago, Realty Income has lifted its dividend 113 times, including 96 quarters in a row. This latest raise pushed the dividend yield over 4%. As a guy who's into dividend growth investing and as the caretaker of the Income Builder portfolio, one of my favorite things to see is what I call a stairway to income heaven, and Realty Income's dividend trajectory definitely has a beautiful stairway pattern. But this company is about a lot more than the income it produces. It's a high-quality real estate company that's one of the leaders in its industry, and it's a stock with an enviable long-term history of outperformance. $100 invested in Realty Income in 1994 will be worth about $3,600 today, about twice as much as a similar investment in any of the major stock market indexes. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk more about this fine company, please do us a favor to help grow our channel, okay? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Okay, now let's talk about Realty Income's history, its business model, why I've selected it several times for the Income Builder portfolio, and how it might interest those who use DGI as an investing strategy. Realty Income is a real estate investment trust, also known as a REIT. It was founded in 1969, with its first property being a single Taco Bell restaurant. The company began trading on the New York Stock Exchange in 1994 under the ticker symbol O. Within 2 years, Realty Income received investment-grade ratings from the leading credit services. The business continued to grow, and by 2011, O was acquiring $1 billion of new property annually. Realty Income paid $3.2 billion to acquire rival American Realty Capital Trust in 2013. 2 years later, Realty Income was added to the S&P 500 index. In 2016, O surpassed $1 billion in annual rental revenue for the very first time. The company expanded its operations into the United Kingdom in 2019 when it acquired a dozen properties that were entered into long-term net lease agreements with the Sainsbury's grocery chain. That was the start of a $3 billion plus investment in Europe, covering 114 properties. In 2020, after raising its dividend for the 25th consecutive year, Realty Income became a dividend aristocrat, making it one of only 3 REITs to have achieved that lofty status. On November 1st of this year, the company completed an $11 billion acquisition of competitor VREIT. Realty Income then spun off many of its office assets into a new company, Orion Office REIT. The Income Builder portfolio received shares of Orion, and we promptly sold them. I'll talk about that in a couple minutes. Realty Income buys commercial real estate leased to clients under long-term agreements. Most of its contracts are structured as triple net leases. This is a great business model for Realty Income because it makes the client responsible for each property's operating expenses, such as maintenance, insurance, and taxes. That triple net structure reduces a REIT's exposure to rising expenses and preserves a predictable cash flow stream, a stream that Realty Income uses to pay its monthly dividend. Realty Income owns more than 7,000 properties, with about 650 clients operating in 60 industries. There's properties in every state, as well as in Puerto Rico, the United Kingdom, and Spain. Most of these properties are freestanding buildings in prime locations. Realty Income has grown by being a serial acquirer. The analysts at Morningstar give Realty Income an exemplary capital allocation rating, saying, quote, "In our opinion, the company's balance sheet is sound, its capital investment decisions are fair, and its capital return strategy is appropriate. We attribute most of Realty Income's growth to the skill of its management team. What also impresses us is management's ability to significantly increase the portfolio's quality over the past decade. Realty Income has shifted its exposure away from economically sensitive retail segments like full-service restaurants to retail segments that are much more insulated from economic downturns and e-commerce," close quote. Not being adversely affected by e-commerce is important, with tenants like Home Depot, Kroger, Dollar General, Lifetime Fitness, Circle K, 7-Eleven, Regal Cinemas, and FedEx. Very few of Realty Income's tenants are at risk from what I call the Amazon effect. In addition to being less affected by e-commerce than most other REITs, Realty Income makes a convincing argument that it'll be less affected by one of today's economic buzzwords, inflation. Historically, the stock has performed well during inflationary times, partly because the company's leases have built-in rent escalators. As the company says, inflation translates into stronger fundamentals for our clients' businesses, leading to higher rent coverage ratios. And as the prices of raw materials, land, and labor increase, the value of our existing portfolio increases as well. Realty Income's main trouble spots the last couple of years were theater tenants Regal Cinemas and AMC Theaters, which were severely hurt by shutdowns during the COVID-19 pandemic. But during its third quarter earnings report on October 1st, O reported that those tenants were able to pay 99.6% of the rent they owed. Rather than earnings, a REIT's performance is measured by adjusted funds from operations, and Realty Income had a stellar third quarter, with 12% growth in that department. Sales growth also was outstanding at 22%. Robust growth is expected to continue into next year, with adjusted adjusted FFO projected to rise 10% to $3.85 per share. And from a quality standpoint, Realty Income checks so many boxes. In addition to the exemplary mark that O gets from Morningstar for capital allocation strategy, the company has received a solid A- credit rating from Standard & Poor's, and it gets good grades from Valuation, a 2 for relative safety and an A for financial strength. Now let's talk some more about my favorite subjects when it comes to Realty Income, the reliable, ever-growing dividend. Like all REITs, Realty Income is required by U.S. law to pay at least 90% of its taxable income in the form of dividends every year, and this company wears that requirement like a badge of honor. For example, in its November investor presentation, the word dividend was mentioned 25 times. The Who We Are page included the statement, "We invest in people and places to deliver dependable monthly dividends that increase over time." And the next page described the commitment to the dividend as sacrosanct, a word whose synonyms include holy, hallowed, sacred, and untouchable. As an investor, I've learned to never say never, so I won't claim Realty Income will never cut its dividend. I'll just say I'm very confident that O is highly unlikely to reduce or eliminate the payout in my lifetime, and I plan to be around for a while. The dividend has made it possible for Realty Income to outperform the S&P 500 index over the long term, as this fast graph's image shows. If you invested $10,000 in Realty Income 15 years ago, you'd have received nearly $2,000 more than that back in dividends alone. A similar investment in the S&P 500 index would have only generated about $3,400 in dividends. That disparity helped the investment in Realty Income grow to $38,000 compared to about $36,000 for the index. From its marketing campaign to its logo to just about every discussion it has, the company makes sure everybody knows it pays its dividend monthly. Some dividend growth investors love monthly payers, but it's really not that much of a factor for me. I'd own Realty Income in my portfolio, and I'd have selected it for the IBP even if its dividend was paid quarterly, as is the case with all of our other positions. Realty Income has been a slow and steady dividend grower, averaging 4% annual growth the last 5 years, 5% the last 10, and 5% the last 20. Its dividend gets a safe 70 score from Simply Safe Dividends. The company tends to issue small raises for several consecutive quarters before making a much larger increase. A year ago, Realty Income's monthly dividend was 23.4 cents a share. It then had 4 straight small raises of 0.2% before coming through recently with a 4.2% quarter-over-quarter hike. So overall, the monthly dividend grew 5.1% to 24.6 cents over the last year. All right, now let's talk about how buyable Realty Income is. Analysts tracked by tip ranks consider O to be a moderate buy, with a price target that offers an upside of about 10%. Reuters surveyed 19 analysts, with 11 giving O either a buy or outperform rating. Refinitiv collected data from numerous analysts. Their mean price target is more than $79, about 12% higher than now. Morningstar considers Realty Income to be fairly valued, saying the stock is currently worth $71 a share. Valueline says O could see more than 50% price appreciation over the next 3 to 5 years, to as high as $110 a share. But Valueline's shorter-term forecast doesn't see much of a gain, only about 5% over the next 18 months. Pointing to continued high occupancy, the quality of Realty Income's properties, and the consistency of its rent collections, analysts at CFRA call O a buy, with a $78 target price. Looking at fast graphs, Realty Income's current blended price to adjusted funds from operations ratio is just a little higher than its 10-year norm, suggesting the stock is fairly valued to slightly overvalued. The yellow highlighted area of that graphic indicates that Realty Income is expected to average almost 8% AFFO growth over the next 3 years. That's quite good for a slow and steady REIT. I own a pretty good chunk of Realty Income in my personal portfolio, and I've also selected it numerous times for the Income Builder portfolio, the public real money project I manage for this channel. On Monday, November 22nd, I executed a purchase order for about $500 worth of Realty Income on behalf of this channel's co-founder, Greg Patrick. I split the other half of Greg's $1,000 semi-monthly allocation between 2 of the IBP's smaller positions, defense contractor Northrop Grumman and healthcare conglomerate CVS Health. We initiated our Northrop Grumman position back in February, and it's experienced about 23% total return since then. Our CVS position is up about 11.6% since we bought it in June. Both CVS and Northrop still look fairly valued to somewhat undervalued. As I mentioned earlier, Realty Income spun off some of its office properties to form Orion Office REIT. I didn't feel the company's new holdings were of high enough quality, so I immediately sold the 2 shares the IBP received, and I used the $44 in proceeds to buy about 0.6 of a share of Realty Income. The portfolio also received $13 of cash in conjunction with the spinoff, and I used that to buy another fraction of a share of O. After all those transactions, the IBP now owns about 34 shares of Realty Income, which is expected to bring about $100 in annual income into the portfolio. We also own about 15 shares of CVS and just under 5 shares of Northrop Grumman, and each of those positions is projected to generate about $30 of income over the coming year. If you want to learn more about these or any of the 45 stocks in the Income Builder portfolio, please check out the link in the description. Sign up for our free subscription to the Dividends and Income website, and you'll be notified about the stocks I'm adding to the IBP in real time. Okay, that's all for today, folks. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.